With motivated sellers, these units can become your leverage buys. The smart investors of Dubai who have almost quadrupled some of their investments. As an investor, you need all the information, all the reports, all the numbers at your fingertips before you actually decide. Now, there are different kinds of service charges. We're going to address all of these, and I'm going to give you the blanket formula for this as well. These are 7 lessons that I will teach you to make sure that you are on top of your game. The hype versus reality. Now, what most of the people who actually inquire or even think about investing in Dubai, this is not just real estate, any sort of investments in Dubai, be it in a business where you're buying a running business or you are starting something of your own. What multiple people do is they follow the hype. They start following what looks good on Instagram or just on YouTube or on TikTok or on Snapchat. What this market has taught me for the last 20 years, these are 7 lessons that I will teach you to make sure that you are on top of your game. Now, I made a reel on this specific topic, but I'm going to repeat it for our viewers on YouTube. How did I start off in this industry? I was an investor first. My first property was a studio. My second one was a townhouse. My third one was a 2-bedroom. Now, the first lesson, this is the code that you need to understand when you are going through listings online or any sort of real estate listing website. The first one, investor deal. That means there is something wrong either with the floor plan, either with the view, either it's unlivable. Now, that's why the price is again going to be lower compared to the market rate. This is your leverage buy first. Before you go and bite into that deal, you want to make sure you understand what you're getting yourself into first. Second one is motivated seller. What does that mean? Either the unit has been empty for the past few months without a tenant, which is obviously bleeding the owner with either the monthly mortgage payments or the service charges or whatever it is. Every month that goes by is a minus for the owner. That is what is meant by motivated seller. They want to liquidate. You need to understand what is going on between the lines. With motivated sellers, these units can become your leverage buys where you can go in hard with your negotiations. Of course, make sure you understand the specific project that you are going to negotiate for. Where is that specific project or building located? How is that area doing? What are the numbers of that specific area? Has the market climbed? Has the market dropped? You need to make sure you know these things before you go in for a leverage negotiation. High ROI, 8%. This is what they would market, high ROI. Now, usually when they're calculating this ROI, they have not calculated your service charges, your damage charges, your vacant time. Once you do have all of this calculated in, the ROI comes down to probably half of that. Make sure you're doing your numbers right, or make sure you have a consultant on your side who knows the game. If you want a blanket formula, this is the one that I use. The more adjectives used to describe a listing, there is something usually wrong with it. Good properties sell themselves. Good projects sell themselves, be it in the secondary market or at launch. Now, this is a part of lesson number 1, which is what you look at and you understand what the listing actually means. Now, let's talk about lesson number 2. We will talk about the service charges. Service charges is an amount that is charged by the building management or even the bank when you are taking your mortgage. Now, there are different kinds of service charges. We're going to address all of these, and I'm going to give you the blanket formula for this as well. Usually, when it comes to townhouses or villas, you are looking at villas or townhouses. You're looking at a per square foot charge. Now, this is already a charge which is incorporated in your yearly service. That's what you pay on a yearly basis to your community management company or whoever's managing the community or the building itself. So, for villas and townhouses, it is between 3 to 5 AED, which is dirhams per square foot of your built up area, Now, when we talk about built up area, for example, you have the internal space and then you have the external space. So let's talk about villas first. So your total built up area, say for example, it is 4,000 square feet. So it will be 3 or 5 or 3 or 4 or 5, depending on which community or which developer you are with. You need to calculate that per square foot of your total built up area. If this is a 4,000 square foot built up area, it will be multiplied into 3 or 4 or 5, and that is your yearly service charge. So for villas and townhouses, you have 3 to 5 dirhams, and in certain branded cases, it goes up 6 to 7 dirhams as well. Now we look at apartments, is approximately 13 to 20 dirhams per square foot of internal built up area. I will come back to that just in a bit. Now, apartments is always going to be a little bit more expensive because your built up area is small and they have to manage the entire building and the tower and the amenities and everything. So the cost's a little bit higher. Now, when it comes to branded apartments, it will obviously go higher. It will be on the higher side, between 18 to 20 dirhams. The median is between 15 to 17 dirhams. And then the lower side is between 12 or 13 to up to 15 dirhams. It really depends on the project that you're in. Now, when it comes to apartments and balconies, the balconies is calculated, the balcony area, say for example, I have a 100 square foot balcony or a 200 square foot balcony, it will only be counted as 25%. Now, some developers may charge you higher or lower, but the market standard is 25% of the total square foot of the specific balcony. Now, these charges are usually the charges that are introduced to you either in off-plan or when early stages of the building handover. Over the years, as years go by, depending on how the building or the area or the project has been maintained, the service charges can fluctuate. If they've maintained poorly, those charges actually climb. If they've been maintained well, those charges may decline as well. Let's look at lesson number 3. Now, I'm going to talk about an age-old debate of ready properties versus off-plan properties. When it comes to ready, of course, you can actually go, touch, feel, see. You can see the view, you can see the actual layout, you can touch the walls, you can see the quality, you can see what sort of amenities are in the building or in the area or the community. You can see what sort of appliances or what sort of furniture that has already been installed in these apartments or units. However, when it comes to an off-plan project, many people actually think that this is a dream with a payment plan. The smart investors of Dubai who have almost quadrupled some of their investments. I'm talking about in the last 3 to 4 years. I'm not even talking about 2008, 2009. I'm not talking about Palm Jumeirah. I'm not talking about Pearl Jumeirah. I am talking about in the last 3 to 4 years, people have quadrupled their investments, and 90% of those investments, which were double, tripled, are all in the off-plan stages. Yes, you can talk about it being the COVID, it being a pandemic, it being a world pandemic. You can make all the excuses you want, right? But the point is, the real cash is always made in the off-plan stage. If you want to get out early, if you are not waiting for a decade for the appreciation to go up, then off-plan is your bet, your best bet. However, it can very easily become a liability instead of an asset if you are buying with a smaller and unrecognized developer or a fairly new developer in the market. Look, I have nothing against the new developers. Some of them are doing really good work. If they don't have a track record, if they don't have any big names backing them up, then that's already a higher risk for the investor. Now, when you look at bigger names, when they come up with new communities, now the best time to get a guarantee on your investment is investing with bigger developers, more established developers, especially if it's a new master community that they're about to launch, right? The first phase of a new master community with a well-established developer, now that is your pot of gold. That is where you're gonna get a guaranteed appreciation. I mean, I won't say it's 100% guaranteed because, to be very honest, the Almighty is the only one who can tell you about a guarantee. However, if you look at the patterns, you look at how every single person who has made good money in real estate, who's not a developer, who's just an investor, these people have always invested in bigger names like Emar, Demac, Haptur, some of these other names also that I'm not going to take right now, in their first master communities, in the first launch, or even the second launch, where these guys have doubled or tripled their investments. So before jumping into any sort of investment opportunity, be it off plan, be it secondary, you need to understand with secondary, there are multiple options that you may get in the market, especially in a down market. But then again, you will also get amazing deals in the primary segment with the developers in the down market, because that's when those specific developers actually get more flexible with their payment plans, with their price points, and you also are able to get some waivers and discounts and things like that. But with developers, you have a wider choice. Now, not like some other projects which are sold out on the same day. Like very recently, 2 projects with a combined value of 6 billion was sold out. Now, coming back to the developer, you get multiple options when you buy with a developer. You get to choose your flow, you get to choose your floor plan, and then you know what you're going to get. But if you are going into the secondary section, you are not going to get a choice. You're going to get certain choices with a certain type of a view, with a certain type of a layout, and you have to either take it or leave it. Now, keep in mind, when you're looking at those kind of opportunities in the secondary market, there must be a reason why that specific person is selling off the unit. Do not buy it unless you visited it yourself or you've had an experienced consultant come with you and do a survey with you before you put your hands into anything. The next lesson is mortgage or finance. When it comes to finance, you need to look at your processing fees. You have your processing fees. Then you have your interest or the profit margin. If it's an Islamic finance, conventional finance, you have interest. The Islamic finance, you have your profit margins. I will talk about what the difference is also just a little bit later now. And then you have your pre-closure fees. Now, pre-closure fees is all about, if you want to get rid of one mortgage a little bit earlier or before time and then move on to another one. This would usually happen in terms of investors. Investors who want to leverage the bank, want to leverage finance options and want to grow their portfolio. The pre-closure does not apply to an end user who's just going to buy that one villa or one townhouse or one apartment and wants to live there until the next 15, 20 years and, then maybe look at something else after that. Because usually people like that would completely pay off their loan and they wouldn't want to pre-closure. They wouldn't need to pre-close, right? But I'm going to talk about these at the moment. So when it comes to the processing fees, when you apply for the loan, there's approximately a 4%. Now, this is an average. Don't quote me for my numbers. This is more of just for information. The processing fees, you'd end up paying about 4% of the total value which was financed. Okay? Interest or profit is between 3.6% up to 4% per annum, per year. That's the amount of interest or profit that you'll be paying the bank for every year that you take the loan out on. That is the total value that you are going to pay, or the total value of the finance that you're taking from the bank every single year. Then your pre-closure comes out to be approximately 2% of the remaining amount of the principal at the time of pre-closure. Now, what does this do? If you are going to take an apartment where your rental returns, let's say on an average, after your service charges and your vacancies and your damage is going to be approximately 6%. If you're going to take an apartment like that, you end up paying 4% in the beginning. Then you're paying about 3.5% to 4% every single year to the bank. And then at pre-closure, you pay 2%. I'm not even going to go into the details here, but just to give you an approximate average, like an average, you're going to end up making just 2% or maybe 1% in total if you leverage the bank. Now, usually you need to leverage the bank when you are buying a ready property or which is close to handover. During the off-plan stage, you get a payment plan which is usually very flexible with multiple developers given the current situation. So it's more affordable, it's within reach for those people as well who couldn't buy in the last few decades in Dubai. If you want to do a deep dive or understand what your finances are capable of, send me a DM, register below in the Calendly link, and we will link up and go through your numbers, and then you'll have a clear path on what sort of property you can afford. Forget which one you want to buy in the beginning. We need to know that which ones you can afford as per your specific finance situation. All right, the next one. Now, this topic is kind of guiding me towards talking about the ROI, which is your return on investment. How do you calculate your return on investment? Now, there are multiple ways that you can actually do that. The most simplest way is if you have an apartment for 1 million dirhams. 1 million dirhams is what the apartment cost you, for example, right? Now, say, for example, this specific apartment is a 1-bedroom, and this is going to fetch you approximately 80,000 dirhams in rent. This is going to get you 80,000 dirhams in rent once it's ready, and once the building is ready, you can start charging 80,000 dirhams. Now, say for example, this apartment is 700 square feet of internal area, give or take, and let's say the maintenance is 15 dirhams into 700. This would be around 10,500 is your maintenance charge or your service charge for this apartment once it's ready, and that is applicable from year 1. All right, so now you've gotten 80,000 on a 1 million dirham account property. So 80,000, that makes it 8%, correct? Now you minus the 10,500. This will come down to approximately 69,500 in terms of what is available. Now, this is the most ideal way of calculating it. All right, you get your rent, you minus the service charges, boom, that's my net. Now, yes, this is the most ideal way to look at it. However, you have to consider that sometimes your apartment would be empty for a few months, right? And especially if you're traveling and if you don't know how to make sure that the apartment is full, you don't want to take that headache on, or you're just, too busy to take that headache on. On top of that, you have repair charges, because certain things the building management will repair for you, not everything. Now, again, it also depends on if you've given your apartment as it was, if it was furnished already or not. If you need to repair some of that, any of those damages, anything that goes wrong, all of these things need to be taken under consideration, right? So for that, let's say we add in, let's say, a miscellaneous charge of approximately 4,500 dirhams just to make it even. This would take it down to 65,000 dirhams is your net. So it would become 6.5% ROI. That's how you want to calculate your ROI in terms of rental. Now, this is the most easiest way you can look at calculating your ROI. What people also don't look at is when you're buying an off-plan property, you've bought it at a certain value. Say, for example, you bought it at this value. For example, there was a launch just now by Beyond Arancia. The 1-bedroom apartments were approximately priced at 1 or 1.1 million, right? Let's say 1 million apartment is bought. You've paid 10% down right now. Then you pay 10% after another month, and then you have 5% after every few months. That's a pretty decent payment plan, and it's a 4-year payment plan. Now, this is going to be handed over, this apartment would be handed over in 2029. So that is giving you approximately a 3.5-year lead time. Now, yes, you're not buying a physical apartment right now. You're buying into a plan. You're buying into a well-reputed plan, reputed developer and its plan. You're not just going to get the rentals of today. You're going to get the rentals of 2029. Now, if you look at those areas, you study what's the sort of percentage that the value or the demand will grow over the next few years. That's how you calculate your AAGR, which is the average annual growth rate. There are some areas which are looking at growing up to 15% per annum. For example, Jaddaf. Jaddaf has 4 major government anchors coming in, and the forecast of rental growth is approximately 15% every year for the next 4 to 5 years. So a simple studio in Jaddaf today, which is approximately priced at around 70,000 dirhams, will grow up to be around 93 to 95,000 dirhams by the time it's 2029. So similar ways, each area has its anchors that drive the appreciation or the growth value. Now this leads me to my next lesson, which I mentioned earlier, that good properties sell themselves. Yes, good properties do sell themselves. However, information or education is imperative, especially for an investor or a new investor who has the money but doesn't know where to actually invest. Now, there are multiple developers, huge developers, tier 1, tier 2 developers in Dubai that still have launched projects that many investors aren't aware, especially investors that are new in the market, who are not serial investors, who are not institutional investors. These guys have a little bit of money and they want to make money. Now, Dubai is the playground for such people who want to come in, make your investments, grow your portfolio, and actually start making your own generational wealth. Now, education is, when I say education, this means that as an investor, you need all the information, all the reports, all the numbers at your fingertips before you actually decide. You know, this is like something what I do with my investors and my clients is I make sure that they are aware of all the options available. They're aware of all the numbers. Now, obviously, when I say all the options, it's not going to be every single project in Dubai, because that's a waste of my time and yours. Obviously, first I would understand what's your budget, what's your finance situation like, what is your cash flow for the next 3 to 5 years. Accordingly, we would shortlist projects that fit your financial situation, and then we would talk about options within those opportunities. I talk about all developers, all sorts of projects, but then again, I don't sell all developers or all projects. If the numbers match, if the numbers make sense for me, that's when I would even talk about it with my investors. Which leads me to my final point for this specific video. Invest in the area, not in the project. Yes, you do invest in the project. However, that should be secondary on your drawing board or your planning stage. The first planning stage should be the area. Which area do you want to invest in, and what do you look at when you are investing in an area? The first thing you want to look at the anchors in the area. When I say anchors, these can be either government projects or even private developer projects. If a specific project or a building or anything that is being built in an area which will add to the GDP, which will add to the rental growth, which will add to the portfolio and the caliber of people living in that specific area, then that project is called an anchor. To give you an example, let's talk about Jaddaf. If you guys haven't seen my Jaddaf video, I will leave the link down below. Now, when it comes to Jaddaf, for an example, Jadaf has 4 major anchors coming up in the near future. You have the first one, which is going to be opening this year, which is the DEWA headquarters, Dubai Electricity and Water headquarters. Now, that is a commercial building, it's a government building, but it is going to add to the GDP or the growth of the area of Jadaf. Why? Because it's going to attract another 5 to 10,000 people who are going to be working from that building. People will want to live nearby. Second, it's going to obviously add traffic coming in and going out of the building every day, which means, again, restaurants nearby, shops nearby are going to see more business in the area. The second anchor of Jadaf, again, is the extension of the Blue Line Metro, which is adding another metro station directly connected to Jadaf from Creek Harbor. Which means what? People working in that area can actually travel down and even live in Jadaf. So going on, so on and so forth, there are more anchors which you can watch the video and see. The anchors is what you need to look at in any area before you decide on which area you want to invest in. If you want to understand which anchors are coming up and there is a certain area that's in your mind that you want to look at, or there is a certain list of areas that you want to explore, send me a Calendly request. You'll find the link down below and we can discuss which areas you are interested in. We can look at which anchors are actually coming. We can identify those anchors for you and then you can make a well-informed decision. So for those of you who follow me, drop me a like. It really helps the channel. And for those of you who don't follow me, do hit the subscribe button. Send me a message if you have any questions. I'd be more than happy to walk you through them and we can discuss opportunities that would actually suit you and your financial situation.